Well, sentiment stayed firm last week with the S&P 500 gaining ground for a sixth week in a row, marking the best run of the year so far, while the dollar continued to flex its muscles against most G10 peers. The week ahead is somewhat quieter, with the data docket relatively barren, although the BOC are set for a 50 basis point cut and corporate earnings season continues to ramp up. Though the week ahead is very much likely to be the calm before the storm, as market attention soon turns towards the presidential election, now just 2 weeks away, as well as a slew of central bank decisions and big data releases towards the start of November. Plenty for us to discuss on the trade-off this week. Without further ado, let's get into the show. So an interesting week for markets last week, but this week looks like it will give us a bit of a chance to pause for breath and reflect on what's gone on and what is likely to happen over the next 10 days or so. Joining me, as always, to try and make sense of everything is my good friend, Ryan Littlestone from Forexpo Live and Forex Analytics. And Ryan, I think before we get underway, I'd like to just say that any mention of football is banned on the show this week, given the results that we both endured over the weekend.
Football? What's football? I don't know this strange term you're using with me. Football? No, never heard of it. I'm a cricket man.
Well, I was going to say the good news is the autumn internationals in the rugby union start next weekend, so we can have something to distract ourselves with.
Yeah, a bit of egg chasing. Love a bit of egg chasing, yeah.
Indeed. Certainly the way we played on Saturday, I think egg chasing would go better. Anyway, let's have a look back at last week and also look forward to the week ahead in Topical Thunder. So I want to start with a bit of a look at the sort of themes that are driving the foreign exchange market at the moment, because I think we're in a fairly interesting spot. And as I said, now is as decent a chance as any to take a bit of a step back and reflect on what's going on. And I think it's interesting because we went through the third quarter of the year, particularly the back end of Q3, where the foreign exchange market was really a story of rate differentials. We saw everyone focusing on which central banks would ease the most and the quickest, and of course, by extension, which would ease the least and the slowest. And that's why we saw some of the moves that we did, where the Aussie dollar gained ground as the RBA remain a hawkish outlier, and also why cable ran all the way up towards 134 as markets bet on a relatively more hawkish path from the Bank of England. And of course, the 50 basis point cut that we saw from the FOMC in September was really what gave markets the ammunition to focus on that theme, both the run up to that cut and then its delivery itself. But in many ways, that 50 basis point move from Powell and Co. has actually opened the door for other central banks to really up the ante in terms of dovishness of their own policy decisions. Now, of course, you look last week, we had the ECB. They delivered their first back-to-back 25 basis point cuts in over a decade. You've also got data, which we'll get onto momentarily, pointing to the BOE likely going in both November and December as well. This week, and I know Ryan's going to talk about this momentarily, the Bank of Canada, they look set for a jumbo 50 basis point move of their own. So we've gone through that kind of 8 to 10 week spell where it looked like there was going to be a bit of policy divergence. And we're now back in an environment where it looks like instead G10 central banks are going to ease policy in a relatively synchronized manner, both in terms of the pace and the magnitude of those cuts that are likely to be delivered. And for me, Ryan, that has two implications. The first is that the backdrop for risk remains incredibly supportive, with those policymakers backstopping sentiment quite significantly. And the second is that given the data that we're getting, that focus back on growth differentials rather than rate differentials, particularly in the foreign exchange space, really makes it hard, if not impossible, to be betting against the dollar at this moment in time.
Yeah, well, my first question is, do you remember the 10 years ago when the ECB did back-to-back rate cuts, where you're running around school in your shorts and scuffed shoes playing kiss chase?
I was probably still wearing short trousers in those days, only just.
Exactly. But yeah, your point's absolutely right. It does seem like we've entered some sort of, well, alternate universe where 50 basis point cuts are now the new normal. Don't ask me how we've got there, but it does look a bit synchronized. I'm not sure if synchronized is the right word. I think a lot of these central banks are now worried that they're going to be caught on the downside of inflation as they were on the upside of inflation. And I think they may just be covering their backsides. I nearly said arses then, just covering their backsides. Just covering their backsides in case, inflation is going to undershoot their targets. They don't want to be seen being caught out once again. And the Fed, we said it at the time, they've opened up the can of worms to the 50s. We've got other banks doing it now. The ECB held back, but yet the market still expects more. The question is, where do they stop? Are they going to stop at their neutral levels, or are they going to be forced to keep going and indeed then becomes more stimulative rather than ending restrictiveness? And those are two different things, very different things for markets. And that's the position we're in at the moment.
Yes, absolutely. And we are still in that period of removing restriction and getting back to neutral. We've still got the fun and games of trying to work out where neutral is, because for those of you who are unfamiliar, the neutral rate is a very fuzzy concept, which is why we always talk about around 3% for the Fed or around 2% for the ECB. It's one of those things that you only really know that you're at neutral when you've probably gone past it and you've done a little bit too much. So there you go. There's 2025's central banking theme in a nutshell from Mike and Ryan. In the here and now, though, we hear from the Bank of Canada, Governor Macklem and co. this week.
Yeah, and as I've just said, 50 BP cuts are now the new 25 BP cuts, and perhaps that's inflation for you now that they have to shift up a gear. And this week's Bank of Canada.
Sorry, I was going to say the other one is the RBNZ. Some on the sell side are even talking about 75 basis points from them, and the market's pricing a negligible chance of that as well.
Yeah, well, it always happens. We always say there's some in the market who like to go to the extreme sides, running too far to one side of the boat or the other. For me, that gives us just a trading opportunity. There's no way the RBNZ are going 75, and I'll have another bet on that I'll have another bet on that if you want to take the other side of that coin. But
the way our bets work is I lose and you settle, so I'll happily do that,
mate. Not this time, mate. If you have another one, I'm definitely naming you. But anyway, this week it's the Bank of Canada deciding on whether they need to panic now and go a 50 after cutting 25 pips apiece for their last three meetings. Once again, there are pros and cons for them going a 50. On the pro side, last week's headline inflation numbers came in lower than expected and have dropped significantly since their last meeting in September. We also had the BOC Business Outlook survey, which didn't really make much good reading, but there was a jump in optimism there for the months ahead. Wages, they continue to ease as well, as the Bank of Canada have been telling us. So there are worries as to why they may go 50. On the other side, there have been two positive jobs reports, the last being very good. Monthly GDP was up in July, although they expected to come in flat in August in the flash number. Core inflation came in unchanged last week, and in some of the measures went up in others. So there's still a lot of stickiness in those core inflation measures. So overall, there's definitely factors for and against going a 50, but is a 50 after a round of 75 basis points of cuts a bit of overkill? Probably not in the eyes of central bank these days, but they have worries over overshooting inflation targets on the downside and economies weakening. So maybe they're a bit scared, and that's going to get them into pulling the trigger. After all, as they were so wrong to act on inflation on the upside when it came, so they are scared of ending up doing the same on the downside. So for me, it's the same as the other 50 basis point cutters like the RBNZ. Do they really need to? Maybe not. Will they do it? They probably will.
I would agree with that. I think that sort of scarring from the whole transitory experience that we saw, in 21 and 22, and even in the first half of 23, is probably in the back of policymakers' minds. It's bad enough to make one mistake and get caught out by inflation on the way up. You don't really want to be caught out by it on the way down. I guess the way I would frame the BOC is, where is the path of least regret for the people who are sat around that table in Ottawa when they come to that decision. You look at what the Fed are doing, they've gone 50, they've opened the door to that. The ECB easing pretty aggressively. The global path is in one direction. You look at what the market is pricing, the market's discounts around a 9 in 10 chance that they do go by 50 basis points. By extension, if you then go 25, what you actually do is tighten financial conditions and induce a whole load of volatility that, although that's great for traders, it is the last thing that policymakers want to do. Remember that for the last decade or so, their whole aim has been to sap volatility out of policy decisions. So I think really the trade-off for the BOC is, do they go 50 now and potentially that means they get to neutral one meeting earlier, or do they go 25 now, cause a lot of volatility in the market, cause a lot of ructions, and then get to neutral one meeting later? I would say they're probably more likely to plump for the former course, in my view.
Yeah, and I'm very split. I mean, I was a bit split with the RBNZ. I didn't think they'd go a 50, but then on one thing that we noted at that time was that the RBNZ had much higher rates, up close to that 5% mark. So going a 50 in line with the Fed seemed reasonable. The Bank of Canada, they've done 75 pips in the last three meetings, so they're already on their path. They can continue slowly cutting. I don't see why they would go a 50 at this point. But who knows?
Well, indeed, who knows? We'll find out on Wednesday afternoon. Not long to wait. Right, moving on. We need to talk about the Bank of England. Joy, because we had a lot of UK data out last week, and I think all of it raised the chances of, in Governor Bailey's own words, the BOE becoming a little bit more activist in terms of delivering rate cuts. Now, just to break that data down, we had the latest employment data. Now, unemployment did come down to 4% from a prior 4.1, and that's the lowest level since January of 2024. But you need to take this with an absolute shovel full of salt, to be quite honest with you. Even the ONS in the official employment release was saying that pretty much every other labour market indicator is going in the other direction to their official labour force survey, and that they're not quite sure the data is correct. So I wouldn't be placing too much weight on that, and I certainly don't think the BOE will from a policy perspective. Earnings data, though, is not skewed by those same issues. And average weekly earnings on an annual basis, they came down to 3.8% from a prior 4%, and that's the slowest pace of earnings growth in almost 4 years. So a clear sign that the risks of price pressures becoming embedded within the economy is starting to recede. We had a further sign of that in the September inflation figures, which were out on Wednesday. CPI at a headline level coming down to 1.7% from a prior 2.2. That's the lowest level since April of 2020, although again, a bit of a health warning, that will tick higher in October as a result of the increase in consumer energy prices. That said, when you take out food and you take out energy as well, core CPI, that came in at 3.2 from a prior 3.6, and services CPI, that's now below 5% for the first time in 2.5 years. So on the inflation front, very, very good news. And importantly, the headline CPI and the services CPI metrics rising by considerably less than the BOE had forecast in the August monetary policy report. So the progress that we're making in getting back to that 2% target is going quicker than policymakers had previously been expecting. We also had a decent enough retail sales print on Friday. Headline sales rising by 1/3 on the month in September, but almost all of that sales growth came from technology, and the majority of it was driven by sales of new iPhone models, as well as other technology purchases as people go back to school at the start of the new school year. When you dig into the data, it was not exactly the prettiest release, and there certainly is a continued slowdown in spending on some of the big ticket items, which could imply a degree of consumer stress and some belts being tightened, particularly ahead of the budget towards the end of this month. Of course, that is next Wednesday. In terms of the market reaction to that, you've got good news on inflation, Good news on earnings as well. The market's naturally repriced dovishly. The curve now fully pricing a 25 basis point cut in November, while also seeing a 3 and 4 chance of another such cut in December, compared to viewing that as a coin flip about a week ago. And it's another busy week in terms of UK data this week as well. We get the flash PMIs on Thursday, but more importantly than that, we've got plenty of BOE speakers, and those who watch the UK economy closely will know that we don't often hear from the BOE between meetings. We hear from Governor Bailey 3 times this week, as well as external MPC members Megan Green and Catherine Mann, and Deputy Governor Sarah Breeden will be speaking a couple of times as well. And I think this could be the week that the BOE decide to guide that they will indeed be following the ECB's lead and going back to back in November and December.
Yeah, well, that CPI data certainly bore out what Bailey said the week before, didn't it? So, we know that was a heads up, and there's every chance that he may continue that if he wants to get that message across. I think the market's probably about right with 25 pip cuts next month, and then in December. Obviously, the next meeting in November is a forecast meeting, so fortunately or unfortunately, we get a press conference as well to go with it. Your comment on the retail sales, maybe the budget is having a bit of an impact. It's obviously a funny time of year because we do have a lot of these big sale events coming up, Black Friday and the likes. So I think we do see a bit of consumer trepidation, shall we say, maybe just putting off some purchases until they get those big sale points, which, that shows you the state of the world we're in at the moment. Rather than spend now, people are going to wait until potentially they can save a good chunk of money. So that in itself will be something else to see, just whether spending is good over those periods. If it's not, then that's going to suggest some real problems for the consumer. And then obviously, as you mentioned, the budget, that's going to potentially throw everything up in the air. We might need to worry about how much money we're leaving my kids. So, we'll have to think about that one. They might not be getting Christmas presents this year.
Well, I was going to say, the way the budget's going, we're going to be filming this show by candlelight next week. I think. We will see on that one. In any case, Professor Littlestone is now going to give us some trading tips, I believe.
Yeah, I've got my mortarboard, but I'm gonna attempt to give some trading tips here. And this is a subject that I try to teach a lot to traders. It's about why you don't need to have a high or even a positive win-loss ratio. Really, the focus should be on making more out of the winners than you do out of the losers. To do that, you have to approach winning trades with a different mentality to losing trades. Losing trades are more simple. They're limited to my stop. So I know my risk, that's where I'm going to lose, and that's the end of it. But if I'm limiting my losses, why should I also limit my profits to having a strict profit target? I don't like giving up winning trades, first and foremost. If I'm in a winning trade, I will try and push it as far as it will go. I don't have targets. What I do have is places where my trade, if it's in profit, may run into trouble, and thus where I would look to potentially take some partial profits. Now, if you can do this, and if I do this and when I do this, it allows me just to maximize price moves as much as possible. So what I would suggest to traders who want to try this is perhaps follow this example. If you're risking, say, 40 pips on a trade, if you go 20 pips up, cut half the trade for that 20 pips, then move your stop up on the other half 20 pips, now you're at break even. Instantly, you're at break even because you've made 20 on one side, your risk is now 20 on the other half. Now you can see if the price keeps going. If it does, cut more profits, keep moving your stop up behind it. That way, you either keep going with the price move until you either can cut no more and you have to close the trade, or your trailing stop gets hit, which may now be well into profit too. So doing this can massively shift the size of the winners versus the losers, as it means your losses are kept limited while your profits may grow exponentially. We all know it's hard enough to win in this industry, so you need to do everything possible to maximize those wins when they happen.
Indeed, yes. I'm not really sure there's anything I would add to that. I think that's very sage advice as we've come to expect from you.
Yeah. Cheers, mate. Thank you very much. We'll move on then.
Well, we shall. Let's get on to some charts. Right, gold is where I want to kick things off this week, and I'm hoping that Ryan will acknowledge the pun that I've put in the little description at the bottom there in honour of Mr. Kemp and Spandau Ballet.
Oh, God, you moan at me when I do it, and now you're repeating my ones back to me.
Well, I just thought I'd get in on the game. You're lucky I'm not singing, mate. No one would want that.
I'll pay some gold to hear you sing, mate.
I think plenty would pay some gold to hear me not sing, to be honest. Anyway, gold is still a bit of a head scratcher, to be completely honest with you. I'm still viewing this through the lens of a momentum trade because seemingly there's nothing that's going to stop the yellow metals rally at this moment in time. We notched fresh all-time highs towards the back end of last week with spot gold rising north of $2,700 an ounce for the first time on record. And in early trade this Monday morning, we've extended those gains further north of the close on Friday around 27.20. Again, all of this is coming when the traditional quote unquote drivers of gold are pointing in the opposite direction. The dollar is still pretty strong and gaining ground. Risk appetite is very solid, as we see with the S&P having notched 6 weeks of worth of gains in a row, and treasury yields continue to rise, particularly at the long end of the curve. But all of that said, I still don't see this as a move that's worth fading for now. It's very much to hark back to that phrase that we've used so many times this year. The trend is your friend if you are bullish at the moment.
Yeah, very much so. I managed to catch some of this move. I got in gold when we had a dip to 26.22. So I'm riding this one. I bought a bit of a breaker last week through those highs. And yeah, this is one, again, you've just got to try and push it as far as it goes if you're in longs. Where's the top going to be? Who knows? You have to do the same exercise that you do in any market that's rallying and that doesn't have prior price history to base some of your techs off. And it's just let the levels decide and define themselves. You need to get a moment like we got around 26.85 where we found a top. We had a decent pullback. We made support in a particular point, came back up to that 26, 70, 85 area, held it for a while, built a bit of a range. Then last week we broke it. So the same thing needs to happen here. If you're trying to pick the tops in this one, wait for the evidence to do so. We've got a high today, just shy of 27.40. If we spend a bit of time below there, a few days below there, then you're going to see a bit of a pullback, gives you something to lean against, and then you see where the dips go to. So, yeah, there's not much to say about this one. It's going to keep going until it doesn't.
Indeed. Just always believe in your soul, Ryan.
That's it. I'm getting out. There we go. Here they come. Cards are out. There you go. First yellow card.
Good. Oh dear. Right, why don't we move on to dollar CAD?
Oh, I don't know if I want to now. You completely spoiled the plot. But okay, we'll talk about dollar CAD since we've got the BOC coming up. And looking at the price, this one, another strong trend that we've had, the bounce from the lows down at the 134s. At the moment, it seems like a matter of if, not when, we go on and test 140. So with the BOC expected to go a 50 pip cut this week, which may likely come with concerns about the economy, and with the US dollar looking particularly strong still, surely 140 is a done deal, right? But as always, nothing is ever that simple in trading. Yes, 140 may be seen soon, given the trend we're in, but we've also been up here several times previously and failed each time. So there's no certainty that we go and test this 140 area or even break it. Now, there is the risk that given the expectation for the Bank of Canada to go a 50, we might see a bit of a buy rumour, sell fact move in this pair. There's obviously a risk that the bank only go 25s and then we see the Canadian dollar gaining and this pair dropping. Now, if we just look at the technicals, if we do find resistance again at any one of these high points, and that's up in the high 138s, mid 139s and just shy of that 140, we could then see yet another turnaround. However, if we break 140, there's really a lot of empty space until we get to the monster 2016-2020 double top near the 147 level. So the trade I'm looking for in the short term is to buy into any dip, perhaps if the Bank of Canada only go a 25, because they won't stop cutting. And if this US data remains strong, then the trend is going to remain firmly behind bullishness for this pair. For the longer term, trading either a short on another 140 failure or trading a break of that 140 could be a big runner. So there's plenty of ways to cut this one, and you just got to let the market do its thing.
Indeed, you have. I think waiting and seeing is probably the best idea here. Although I'm glad you raised the prospect of buy the rumour, sell the fact trades going on, because looking further out, the market price is 85 basis points worth of cuts from the BOC in just 2 meetings that remain this year, which is quite punchy. And I think it's relatively easy to make the case, therefore, that actually it's relatively, or it will be relatively difficult for the BOC to surprise the market to the dovish side of expectations, which perhaps does raise the possibility of something of a pullback here. But as with any of these major event risks, waiting until that event plays out and then taking a step back, assessing where the market is, that is probably the strategy that would serve best.
Yeah, and if they do go 50 and we get up and test that 140 but can't get through it, then that's perhaps your signal that maybe this particular phase of the move has run as far as it's going to go. But then you've got to quickly switch to the dollar side of things.
Exactly that. Right, moving on to the equity space. We were talking about how gold is a momentum trade. I guess equities are as well. A sixth straight week of gains for the S&P 500 last week, and numerous record highs to boot. There are a few more signs for a market that are more bullish than a market that is continually printing fresh all-time highs, and that is exactly what we are seeing here. And it is still those three familiar forces that are pushing the market higher, with economic growth remaining strong. We had that solid retail sales print last week, particularly the control group measure rising by 0.7% on the month in September, pushing the Atlanta Fed's GDP tracker for the third quarter to 3.4%, a very, very healthy rate of economic growth. Earnings growth is still pretty solid, 3.5% on an annual basis in terms of blended S&P 500 earnings growth so far, although, of course, the Magnificent Seven start to report from Wednesday onwards with Tesla. And then you've got the Fed put, which is continuing to backstop sentiment quite nicely. So I do think that the path of least resistance continues to lead higher, and it won't surprise anyone to know that I'm still bullish on the market over the medium and the long term. But I do think and expect that we might soon see a bit of risk start to be taken off the table ahead of the election. By the time you watch this, we will have 2 weeks to go until Election Day in the United States on the 5th of November. 2 days after the election, we have the next Fed meeting on the 7th. 2 trading days before the election, on the 1st of November, we have the October non-farm payrolls number. If you've been long for, well, the year or even a decent chunk of the year, the S&P is up 20-25% since 2024 got underway. I think it would be prudent, and I think a lot of bulls will be thinking like this, that actually why would we want to run all of this risk into what is going to be a very, very choppy period with event risk that could involve the market in a bit of a tug of war and even see a little bit of downside. So I wouldn't be too surprised if this relatively quiet week that we have ahead, and certainly next week as those event risks get even closer, does see some profit begin to be taken off the table, although I do think that any dips do remain buying opportunities over the medium term.
Yeah, would you say it was 6 straight weeks of gains? I think it's been 6 straight weeks you've featured the S&P on this show. So,
well, as soon as it goes down, I'll stop talking about it.
Oh, that old chestnut, eh? Yeah, as soon as it's out of favour, you can bin it off. Yeah, there's not much to say about this. Lucky there isn't each week. Every time we sit down, there's a new high in play. Yeah, we're getting towards that election. I do think you're quite right. There is going to be perhaps some squaring up ahead of that. But when you've got a margin potentially of 25% gains in the whole index for the year, you really need something bad to happen to give a good chunk of that back. But you won't rule out maybe a 5-10% correction perhaps if the market doesn't like what it gets from the election. So that's always potentially on the cards.
Yeah, the other thing that I would just say on that is you're right, you would need a decent move to wipe out some of that profit, but I think time of year is very, very important. We've got 2 months left of the year. Realistically, it's 1 month because you can pretty much write off December, let's be honest. So if you were to see, let's say your book is up 20% year to date and you see a 5% pullback, you haven't got particularly long to make up that ground to get back to where you were. You're talking 2 or 3 weeks at most. And I think that's something that might end up playing on a fair few participants' minds. But time will tell.
Yeah, absolutely. And obviously, as we get to year end, and we're going to see a lot of people's closing their books, booking those profits for the calendar year at least, to put out all their nice reports. So, yeah, this can be a time when you do see the stock market maybe starting to falter a bit, just on the mechanics rather than there's anything wrong with stocks.
Indeed, yes. Right, moving on, the euro.
Yep, going to have a look at the good old euro, which I think is a real big inflection point at the moment. It's a very interesting junction right now. Things don't look great in the Eurozone, and while the ECB have obviously held off joining the 50 club, the market still expects them to keep cutting rates regularly for maybe another 100, 125 basis points before they finally stop and get to their neutral level. That's in the face of the Fed maybe even pausing or even going slower. So that's now keeping euro dollar under pressure. It's completed 3 weeks of losses last week, and it puts us pretty much right in the middle of a 22-month range. This 108.30, 108.70 is a multi-year zone, and one that's been a very important pivot point for the euro. We tried to break through it last week but failed, although the top level now at 108.70 is current resistance. If we break below this zone and hold it, there's a chance we're heading below or heading towards the bottom of the range, which is down at that 105, 104.50 area. Now, obviously, there's going to be some good levels in play before we get there, and there's a big one down at 107. So if the Fed do remain behind the ECB in cutting speed, there's every chance we could be heading to that 105 area. And what happens there will be very important as well. For now, I expect rallies to be sold, and speaking just of the folks in our chat room, there's a queue a mile long to get into shorts around 110. So that's the main level above. The only thing that's likely to stop the decline is if the US data starts weakening meaningfully from here on out. Then we might see this trend from 112 turn around significantly. But another one, the trend is your friend for this one. And if we break that 108.30, then we're heading a lot lower.
Yes, very much so, and it won't surprise anyone to learn that that is the way that I would be betting that the market does head, even though the ECB have all but ruled out going by 50 basis points in any one clip. The Eurozone economy really does not have anything going for it whatsoever at the moment. I think if people were looking for a bullish play on Europe, the one you brought up recently, actually, going long Spain and long the periphery is probably the way to do it. I would not be touching the euro with a very long stick, let's put it that way.
Okay, well, my stick's probably even shorter than yours, so yeah, we'll measure sticks on Friday, mate.
Yes, let's do that, and in the meantime, let's get on to our plays of the day. Right, 2 FX plays for you this week. Cable for me. We took a bit of a tumble last week after the cooler than expected CPI figures. We actually had a very brief foray back below the 130 figure for the first time in a couple of months. And although we did manage to recover some ground north of that level, I think we are now getting a rather long list of downside risks for the pound to try and deal with. Of course, we were talking earlier on about the fact that the BOE are likely to quicken the pace of policy easing. You've also got relatively fragile growth, as we alluded to with the retail sales data, and of course this fiscal tightening that's coming up in the budget on the 30th of October. Apparently we're going to get £40 billion worth of tax hikes and spending cuts, although you're going to watch this in 12 hours time, and the way things are going, we'll probably have added another 10 billion to it by then. So God only knows what we're going to end up with next Wednesday. That said, I don't think that the pound has particularly much going for it at the moment. And if we were to get another break below the 130 figure, then that is something I would be looking to pounce on from the short side, particularly if we were to get a close below that 100-day moving average, which has held firm since, well, all the way back towards the back end of June. If we were to get a close below 129.60, then I think we could see the bears pile in en masse. So that is where I'm looking this week, short cable. Ryan, we're well, you haven't mentioned the yen for a while.
No, I haven't, but we've got some important things coming up this weekend, and that's the Japanese election, and there's a bit of worry about the weekend elections in Japan, and possibly that the ruling LDP party might not get another majority in the lower house, which would then force it into another coalition like it holds in the upper house. 233 seats is the minimum majority needed. But given how Ishiba is pushing the higher wages line for the future of the economy and finally being able to declare the end of deflation, any upset to that will likely be seen negatively by the market. Right now, the market isn't focused much on the real domestic politics, only whether it will impact government policy and these wage hikes, and thus what the Bank of Japan do. As it may be likely that the elections are going to prove a problem for Ishiba, I'm looking to buy a dip in dollar yen this week to run over those elections. Anywhere down in the mid to low 148s would be ideal, but I'll see what I can get during the course of this week. But I think if the elections don't go according to plan, we're going to see dollar yen rising significantly after the weekend.
Yes, indeed. And actually, that is just another bit of gapping risk that the market has got to contend with. Obviously, we've got the issues in the Middle East geopolitically that have been something to bear in mind. We've also got every weekend China seem to hold a press conference at this point to talk or not talk about fiscal stimulus. So, yeah, if anyone is looking to hold positions over the weekend, Japanese elections. And actually, I don't know about you, but I haven't seen it get probably anywhere near the airtime or column inches that sort of subject deserves.
No, because I don't think, as I say, there's a lot of politics we don't know about. Obviously, Japan population is going to vote for what they see fit. But what I have been reading is that there's going to be a few problems for Ishiba getting the numbers he needs to maybe even continue in power. And that'll be a big monumental shift given the political landscape over there with the LDP being by far the biggest party and in power for so long. So it is a big risk event. And as you say, not a lot of the market's really talking about it. And maybe that's an opportunity, and that's what I'm sniffing anyway.
Indeed, yes, one for us to digest next week, but it could be rivaling Liz Truss for the shortest-lived prime minister across the G7 at this point. Anyway, that does bring us to the end of another show. Thank you very much, as always, for watching. Thank you also to Ryan Littlestone from Forex Live and Forex Analytics for joining me, and to our producer Kyriakos for bringing things together as brilliantly as always. The three of us will be back with another episode of The Trade-Off next week. If you've enjoyed the show, please drop a like on the video, leave a comment as well. Let us know how you're trading the markets. In the meantime, have a very good week ahead, and we will see you this time next week. Thanks for watching. Goodbye for now.